Good afternoon, everyone, and welcome to the latest Institute of Financial Accountants National Online Branch meeting. We hope you're well. We hope your families and your colleagues are all well. It's a pleasure to have a number of you with us this afternoon, and we hope you enjoy this afternoon's session. For those of you who are new to the Institute's online webinars, just a couple of housekeeping points. If for some reason there is a technical hitch, please bear with us. We will look to sort those out as quickly as is feasibly possible. The session is recorded, so if you do miss something, please do request from us afterwards a recording of today's session through myself or one of my colleagues. Probably the most important point to point out is questions. You can type questions using the Q&A button that you'll find, depending on how your screen is structured, either at the top or the bottom. So if you have a question, please do use the Q&A function. I will pick up on those. I will ask appropriate questions as we move through the presentation, or I will leave them to the end, but we will look to answer and cover all questions during the next hour and 10-15 minutes. Great pleasure this afternoon to welcome Patricia Lydon from the US Tax and Financial Organization. Today's talk has come about actually at the request of a number of members that I've met within the last 12 months at branch meetings when we were able to hold those face-to-face. So, a talk that's been requested by a number of members. Patricia is an associate director, having worked for the US Tax and Financial Organization for over 17 years. Prior to that, I understand, Patricia, you spent nigh on 4 years working for Ernst & Young. So Patricia has a wealth of experience in this very interesting, and I think given current times, a very topical moment to be looking at the US tax basics. So enough from me. Patricia, can I hand over to you to start your presentation?
Okay, so I'm going to go over the basics of US taxes so you can all get a basic understanding of, if you have a client, of US taxes that can come up, some of the basics. So today I'm going to give you a summary of the basics, and we'll be covering the following: who is an American, how the IRS is finding Americans abroad, what is FATCA, voluntary disclosure, American tax reporting and investments, gift and estate tax, expatriating from the US, and how we can help you, and any questions at the end that you may have. So I'm going to tell you a little bit about US Tax and Financial Services Limited. US Tax and Financial Services was set up by Darlene Hart over 32 years ago. We have 3 offices in London, Geneva, and Zurich. We have a strong professional team that covers a wide range of services for Americans wherever they may live. We can help them with their individual tax returns, partnership or corporations, or trust and estate tax. Anyone who is subject to US taxes, we can help them. In-house, we have US qualified tax accountants and a US lawyer. We all have Big 4 experience in US taxes. So we're well qualified to deal with many of the US tax issues. So this is more about our company. So now I'm going to tell you who is a US person. A US person is a US citizen who was born in the US and has a birth certificate issued by a US state. There are individuals that may have been born in the US but left when they were very young. These individuals are still American citizens until they have renounced their US citizenship, which I will explain later how to expatriate. If you were born outside of the US and at least one of your parents is a US citizen, you may automatically gain US citizenship. The law is very complex and there are a few factors which you may need to consider. For example, if one of your parents is a US citizen and that parent had spent at least 5 years in the US, of which 2 years of those years were after their 40th birthday, they could be US citizens. So I suggest if you have a situation like this that you speak to us and we can help you with your client. Another way to become a US citizen is by naturalization. Naturalization is the process to become a US citizen if you were born outside of the US. If you meet certain requirements, you may become a US citizen either at birth or after birth. Green card holders. There's quite a few of those around. Green card holders are issued for 10 years, and most people believe if the green card expires, then they are no longer have a US filing requirement, which is incorrect. You will need to formally surrender your green card by submitting a form I-407 to the IRS to abandon their status as a lawful permanent resident of the US. If you know your client has had a green card in the past and they say to you, I've given up my green card, you should ask for a copy of the form I-407 for your records so that you know that they have relinquished their lawful residence in the US, which is, we see a lot of green card holders coming to us at the moment. So, tax residents. Someone can be tax resident in the US if they have spent a substantial amount of time in the US. This could be for work or pleasure. But if an individual has spent an exceptional number of days in the US, they can be resident for tax purposes. So substantial presence test is when an individual has spent a substantial amount of time in the US. To meet this test, you must be physically present in the US at least 31 days during the current year and 183 days during the previous 3 years. And that would make up 100% of the days that you were present in the current year, 1/3 of the days in the previous year, and 1/6 of the days in the third year. And if they've spent more than 183 days, then they would be tax resident for US tax purposes. If they're less than 183 days and they have some US source income, they will be non-resident and they may still be subject to taxes on their US sourced income. So, treaty consideration. If an individual has met the substantial presence test, you can still be treated as a non-resident alien if you have a closer connection to a foreign country and there is a relevant tax treaty in place with the country that you are resident, such as the UK, US and UK have a treaty. You would look at the location of the person's home, where their family is, and where you vote, and where is their bank account, and where do they file taxes. So if they qualify, they've got a closer connection to another country, then we can exempt them from paying taxes in the US, sorry. Okay, so we're going to do a quick poll now. So the first question is, how many of these people do you think are US citizens?
Going up bit by bit. That looks... Oh, there we go.
Okay. I'm not sure, does everyone see the results? So 53%, okay, well, question the first, number one, 27%. 53% said 2 people and 20% said 3 people. So the correct answer is 3. Winston Churchill, his mother was a US citizen, so he got US citizenship through his mother. The Duchess of Sussex, Meghan Markle, was born in the US on the 4th of August 1981, so she's a US citizen. And Arnie was born in Austria, but became a naturalized US citizen since moving there. So it just explains like how you can become a US citizen 3 different types of ways. Also, surprisingly, I'm not sure if people know, Boris Johnson was born in New York, but was still a US citizen despite moving from there at the age of 5 years old. He gave up his US citizenship in 2016. In theory, Boris could become US president if he hadn't expatriated from the US, as he was born in the US. But Arnie, who was California president, not the president, he was head of California, but he couldn't be a US president because he wasn't actually born in the US. So US citizens are taxed on their worldwide income no matter where they live, from when they are born to when they are die. They are taxed on their worldwide income. US residents, which are green card holders and people who meet the substantial presence test, are taxed on their worldwide income as long as they are resident for US tax purposes. So if they're no longer resident, they're not taxed on their income, but they may have US source income and still have a US filing requirement. So how do the IRS see people outside of the US? The IRS believe that US taxpayers living outside of the US are living the high life while stashing their money offshore. Why else would they live outside of the US unless it is to avoid US taxes? This is how the IRS believes people are offshore, hiding their money in the Isle of Man or Guernsey or somewhere like that. So I'm going to do a quick second poll now. So on some of the information I've discussed. So the second question is, if I entered the US on a visa waiver program, which most of us do, this allows an individual to travel to the US for tourism or business for 90 days each year. Would I meet the substantial presence test? That's more than 183 days test.
Patricia, I think from a couple of the questions, or at least the feedback I've seen after the first poll or question, hopefully people might be a bit luckier with the answer to this one. I think some people are a little bit disappointed that they hadn't got the answer right. So let's wait and see.
It is complicated. It is complicated.
Yeah. Keep going. Don't be afraid.
So this is very tight, this poll. So let me end this poll. So 44% said yes, they would meet the substantial presence test, and 56% said no. So the correct answer is no, because you're going in 90 days. So you look at the first 9, so you'd add 90 days, and then you would look at 1/6 of the previous year and 1/3 of the third year. So if they spent 90 days in 3 years, they would have only spent 135 days in the US over a 3-year period. But for example, if they spent, say, in the current year, 140 days in the current year, then they would meet the substantial presence test, because there would be 185 days. So it's similar to some like the UK 183 days. It's just something that you need to pay attention and ask your client how many days did they spend in the US over the last 3 years, which even we do, so we can get an idea. Okay, so the IRS estimates that there are over 7 million US individuals living outside of the US, of which only 12% are compliant with their US tax returns. Tax evasion of the US government is lost revenue, which they believe to be for the tax year 2019 to be lost revenue of $458 billion from tax evasion. All income is taxable no matter how it is earned. You may have heard of Al Capone, who went to jail for 7 years in the 1920s for not paying taxes on his illegal activities. The IRS is actively looking for delinquent filers, and it is now has the tools to find these people.
Patricia, sorry, can I interrupt? Because you've mentioned it a couple of times now, but we've just had a question. What is IRS, please? Sorry.
The IRS is the Internal Revenue Service. IRS is like HMRC, is the equivalent of HMRC.
Thank you very much.
Yeah.
Thank you.
Sorry, I should have explained, sorry. So the IRS has tools to find Americans abroad. So they're finding Americans when they renew their passports, because a lot of Americans still hold that US passport and not filing US tax returns. The IRS has a whistleblower program, which is responsible for processing thousands of tax whistleblowing claims on an annual basis. There's a treaty information exchange between two countries that has a treaty with the US, and the UK and US are sharing information about individuals. But the main one that I'm sure you all see or you may have heard is FATCA. This is huge. This is really big at the moment. Banks are sending letters to all their account holders, which are your clients, asking them to certify if they are US persons and return an appropriate form. The most common form that I've seen people send in to me is a form W7, or they may receive a W8Ben. It's different form. Banks are sending different forms depending if they're US or non-US. But if your client has received this form, maybe they should speak to an advisor like ourselves. FATCA. FATCA stands for Foreign Account Tax Compliance Act. This law requires foreign banks, stockbrokers, pensions, hedge funds, insurance companies, trusts, corporations to report the details of all their clients, account holders, and owners who are US persons to the IRS. This act was passed after the UBS scandal in 2011. This targets non-compliance by US taxpayers with foreign accounts. FATCA is an enforcement mechanism and is not a tax. Obtaining information on US persons is the main reason. This is reinforcement through the threat of a 30% withholding on certain US-based income and other transactions. Withholding can be avoided if foreign financial institutes enter an agreement with the IRS, which they agree to furnish the information on US persons that establish a trusted relationship. To date, over 80,000 institutes have signed up, and over 100 countries have signed an IGA agreement. We are here to help many individuals and companies and trusts to assess if they need to register for FATCA. We assist this with like associate reporting, which is a W8BEN-E, which some of you may have seen. This needs to be completed and submitted for FATCA purposes. So now I'm going to tell you how to get up to date with your US taxes. If the individual has not been filing US tax returns, then there are ways to get up to date. The main one being the Streamline Program, which is for people living outside of the US and domestic people living in the US. I'm not going to go into details about the people living in the US. I'm going to concentrate on the foreign people living outside of the US. The main benefit of the Streamline program is that there are no penalties assessed. Now I'll talk about some of the penalties assessed on certain forms on my next slide. But the main point I need to make very clear regarding the Streamline program is that no penalties will be assessed. You will need to file the last 3 years of your US tax returns and 6 years of a report of foreign bank account, along with a statement to say that you were non-willful with your US filings. We mostly see the accidental Americans born in the US and live their lives here in the UK and then find out that they had to have US filing requirements. When they come to us, and we'd explain that you can go under the Streamline program to get up to date into the US tax system and be compliant with your US taxes. You may have some individuals that want to just file the current year, which is acquired disclosure. The IRS has actively discouraged people doing this, as they will be more than likely audited for the earlier years and assess penalties. So there are lots of forms, but there are lots and lots of forms for US tax returns. But here are just a few of the main ones that we see. The main form is the 1040, which individuals file to report their worldwide income on a yearly basis. This summarizes an individual's income along with supporting forms depending on the type of income earned on a yearly basis. Another form that we see is the form 3520 and a form 3520A. This relates to a foreign trust and, believe it or not, a self-invested pension plan, a SIP, as they would have full control over what they can invest. And in the IRS eyes, this is deemed to be a foreign grantor trust because they have full control over what they can and cannot invest in. And each year they have a filing requirement of this form. The penalties each year for non-filing this form could be as high as 35% of the contributions or distributions to a foreign trust, or the greater of $10,000 or 5% of the gross value of the trust. So you can see how severe these penalties can be if the forms are not filed timely. I have seen some penalties being assessed on the value of the SIP, which is the most common ones that we see. And some of these penalties can be as high as like $700,000 because this is how people plan for the future, for the retirement. So these penalties can be severe, but as I explained, if you go under the Streamline program, you can avoid some of these penalties. Another common form that we see is a form 114. It's for report of the foreign bank account. And this needs to be filed when the aggregate value in your foreign accounts outside of the US, so any accounts outside of the US, is more than $10,000 at any stage during a year. You need to file this form on a yearly basis. If you have not filed this form, there is a potential penalty of $10,000 each year. So you can see, as I explained, the Streamline program is very popular to avoid these penalties because under Streamline, you'd have to file 6 years of the report of foreign bank accounts, which could be the $60,000 penalty. So under the Streamline program, if you have not filed US tax returns in the past, this is the best way to get up to date with your US taxes. So we're going to have another quick poll. So would a US citizen be taxed on premium bond winnings in the US?
Creeping up fairly quickly, aren't they? Yeah.
Yeah, I think people are understanding a little bit. So I'll end the poll. So 74% said yes and 26% no. The correct answer is yes. They will be taxed on their premium bond winnings. Any income that you receive will be taxable for US tax purposes. You will always be taxed. Sometimes this is what I'm going to go explain now in my next slide.
Patricia,
There is some...
Sorry, before you move on, because I think one of your previous, very recent slides, you were talking about the various forms. And one of the questions I've got is, are these forms to be filled annually?
Yes. It depends on each client's situation. So like if they have a foreign bank account and the aggregate value is more than 10,000, you would need to file it annually. The 1040 is like your UK tax return, and that needs to be filed on a yearly basis.
Okay, thank you for that. And sorry, Patricia, before you move on, I've got a couple of people who keep raising their hand. If you've got a specific question related to the talk, or there's something you need to be explaining to me, can you kindly post it through the question and answer area, please? Thank you, Patricia. I'll let you get on.
Okay, so the UK, there is difference between the US and UK tax system. And then as a general rule, what is tax-free in the UK will be reportable and taxable in the US. In the UK, for example, there are tax-free ISAs, but for US tax purposes, these will be reportable and taxable in the US. These could be PFICs as well for US tax purposes, but I'm not going to go into great detail about PFICs at the moment, because these are very complicated and they're very complicated taxes. You have to remember what could be tax-free in the UK will be taxable in the US. Selling your home. In the UK, the gain arising from the sale of a main residence is tax-free from UK taxes, but not in the US. On a sale of a home, if you have lived in the property for more than 2 out of the last 5 years, then you will receive a 250,000 exclusion per person, so a maximum of 500,000 if both are US people. So if your gain, I'll explain a little bit, if your gain is more than, say, 600,000 and you're both US citizens, you will be taxable on 100,000 on capital gains tax rate. But if your gain was, say, 400,000 and you're both US citizens, then there will be no US tax on that gain on the property. You can also reduce the gain on your home with capital expenses, legal fees, capital improvements, legal fees, and commissions. So you can always reduce your gain if you're over that threshold that you may be taxable. But so you'd look at your expenses, your capital improvements over the years that you have had the property. Another important point on properties is that when you sell your home, when you sell your home and repay your mortgage, you could have a potential foreign exchange gain or loss. For example, if you purchased your property in 2008 when the pound to dollar was around 1.8, and then you repay your mortgage at 1.3, if you took out a mortgage for, say, 10,000, the IRS will say you took, in dollar terms, you took a loan out in 18,000. So that's 10,000 pounds times 1.8 was $18,000. And then you've only repaid 13,000, 10,000 times the exchange rate 1.3. So you have a foreign currency gain of 5,000. So your loan was 18,000. You've only repaid 13,000. So there is a gain of $5,000 there. So that will be taxable at ordinary income tax rates. If it is a loss, the IRS says that is a personal loss, so it cannot be taken. Of course, we would look to reduce the gain, the foreign exchange gain, by using unused foreign tax credits, which is UK taxes or foreign taxes paid, to reduce the gain. We could try and reduce the gain as much as possible. So income tax rates. These are the current tax rates at the moment this year, but all this can change next year. if Biden comes in, but these are the current tax rates at the moment. There are 7 tax brackets in the US tax, which start at 10%, and the highest tax rate is 37%. But to get to the highest tax rate in the US, you need to have income over 500,000 for a single person. So it's very high to get to that tax bracket. In the US, there are different ways that you can file a US tax return. You can file single, married filing joint, or married filing separate. If you are a US citizen and your spouse is a non-US person, they would file married filing separate, as you would want to keep your spouse's income out of the US tax system. Married filing joint is the most favorable tax rate for couples filing US tax returns. And that's the best way to file is married filing joint. There is AMT, an alternative minimum tax, and it's a tax to ensure that taxpayers pay at least the minimum tax. The AMT recalculates income tax after adding certain tax preference items back into income. So some people are trying to give a lot to charity, and so this is an alternative minimum tax to stop people to try and reduce their tax rates to 0 to avoid paying any tax. So this is quite common as well. Capital gains tax rates. In the US, capital gains have a short and long term. If the assets have been held for more than 1 year, then it is treated as long term and will be taxed at the 15 or 20% tax bracket, depending on how large the gain is. Short term is taxed at the ordinary tax rates. There is an additional tax, which is called net investment income tax. This is 3.8% tax, and this is tax on investment income over a certain threshold. It wouldn't be taxed on your earned income, it's only investment income. So this is an additional tax, which you can't use foreign taxes, which is like you can't use UK taxes to offset this tax. This is an additional tax. So now I'm going to talk a little bit about US gift and estate taxes. For estate tax purposes, US citizens and US residents are taxed on their worldwide assets on death. If they have filed and paid UK estate taxes as they are resident for UK tax purposes, then we can take a credit for any UK taxes to reduce their US estate tax liability. For non-residents of the US, they are taxed only on US assets, which could be a US pension, a US property, or some US shares held in the US. We would look at the US-UK treaty to see if we can exempt any assets being taxed in US, but most US assets for a non-resident will be taxed in the US. So this is where I'm going to tell you a little bit of good news about US estate and gift taxes. So I've talked a little bit on estate taxes. Now let me discuss how this goes hand in hand with gift taxes and how it can be beneficial to your clients. In the US, you receive a lifetime allowance of 11.58 million, which can be used up between gifts that you have made in a lifetime and estate taxes. Each year, you can gift an individual $15,000 tax-free. So I could gift you all 15,000 to each of you, and there would be no US taxes. If I was feeling very generous and gifted you $20,000, then the first 15,000 would be part of my annual gift allowance, and the remainder, 5,000 per person, will be deducted from my lifetime allowance of 11.58 million. Another point that is very useful to your clients is that a US citizen can make yearly gifts to their non-resident spouse of up to $157,000 a year, which is beneficial if you want to do some tax planning to avoid capital gains tax on a sale of a property. The top rate of estate tax in the US is 40%. So it's the same as the UK. 40% is the estate tax. For non-residents of the US, the estate tax exemption on US assets is, let me start again. For non-residents of the US, if they have assets in the US, the tax exemption on their US assets is only 60,000. So 11.58 million and 60,000. So there's a big difference. If they are above this exemption of 60,000, they will need to file a US estate tax return to release these assets from the US. A lot of people, if it's a US pension, they would want a transfer certificate, which is that you'd have to file a US tax return and the IRS will assess it, and then they will release a certificate, which then you will release the funds from the US. So there's some benefits for the US people, but the non-residents, it is quite complicated to get some of the assets out of the US. So how do you feel about what I've explained to you? I've gone over quite a bit. So most people, once they hear all this, they put their head in the sand and try to forget about it, but you can't. You have to get compliant with your US taxes. You cannot avoid not dealing with this, because the IRS, as I explained, are looking for people outside of the US. Is there a way that you can escape the IRS? Yes. Expatriation from the US, as I explained, you can expatriate, give up your US citizenship. This is the process by which a US citizen and a long-term resident, which is a green card holder, renounce their citizenship. There will be an exit tax if any of the following applies. So if an individual's net worth is excess of 2 million, or their failure to certify that they have been compliant with all of the US federal tax obligations for the last 5 years, or their average net income tax liability for the 5 years ending before the date of expatriation is more than 168,000. They will be subject to the exit tax if they're over 2 million, they've not complied with the filings, or if the average liability is over 168,000. If your net worth is below 2 million, you've complied with the last 5 years of US taxes, and your tax liability is less than 168,000 for the last 5 years, then you would not be subject to the exit tax. This is a big thing. Your assets need to be below 2 million. There are 2 exceptions to this rules if you do meet the exit criteria. People born with dual citizenships and have complied with all their tax obligations for the last 5 years. So if you're born here in the UK and US, if you had US and UK citizenship from birth, you would not be subject to the exit tax. Another one is for those individuals who relinquish their US passport before the age 18 and a half and have not lived in the US for at least 10 years. To relinquish your US citizen, you will need to do the following. Get a second citizenship. So you have to have another citizenship of another country if you renounce your US citizenship. Leave the US. You would have to have an appointment before the US consulate to explain that you want to give up your US citizenship. You would need to file a form 8854, an expatriation form statement, and pay the exit tax, which at the moment there is an exit. So an exit, it's not the exit tax, sorry, it's an exit fee, which the fee is $2,350. So it is very high to exit from the US. So we're going to have another quick poll question. It's the last one. So if you have never filed a US tax return, what are your options? Okay, so 4% said ignore that you're a US citizen. That's not correct. You need to do something. You cannot ignore that you're a US citizen, because as I explained, the IRS are finding people abroad through FATCA. FATCA is the banks are talking between two countries, so they will find you at some point. File under the Streamline Program, 82%, which is correct. This is if you've not filed a US tax return previously. You would file under the Streamline Program. And the third answer is 14% file the current tax return. So as I explained, you should file under the Streamline Program if you've not filed US tax returns previously. Okay, so we're near enough coming towards the end. So as I explained, Americans are taxed on their worldwide income. You should get to know your own client base to see if you have any US clients. Find out if they are up to date with their US tax returns. When preparing their UK tax returns, you should always have a copy of their US tax returns. Can your client ignore this? And I said, as I just explained, no, as the IRS are actively looking for people outside of the US. This is very important. So if you have any clients who are US citizens or green card holders who have spent a substantial amount of time in US, we can help them get up to date with their compliance and help them with their US tax plannings. So if you have any clients, please contact us and we can help you. I must make it clear that these are the current tax laws, as some of the figures may change once Biden comes in. He's planning to raise some income tax for the high net worth people. So the income tax for people earning over 400,000, the tax rate can go up to 39.6%. Long-term capital gains tax could be taxed at the ordinary tax rates. So we should know more next year, depending when Biden comes in, because these were proposals before he became president. So just wanted to make it clear, these are just current tax laws and this may change in the future. And then any questions?
Okay, thank you, Patricia. You've gone through a lot of information there. Very interesting. A lot, I think, to take on board if you do deal with US citizens. Let me go to the questions and we'll run through those one by one. I'll start with the very simple one at the top. Are we able to send soft copies of your presentation to those who've attended today?
Yes.
Yeah, thank you. The next one is from Mohammed Azad, who asks, I have a company registered in the UK, but they are dealing in the USA and doing a lot of business in America and making profit there. They recently want to register in the US. Any contact for US company stroke accountant? I know that's not specific sort of US tax advice.
I can answer the question. Because they're receiving US source income, they would have to file a foreign corporation tax return with the US. So we do have a corporate tax team in our offices who can help with individuals because a lot of people are moving to the US to get some business from the US and asking these questions, should I establish a US business or work for the UK? You will be taxed on the US income that you're receiving, because the US want a slice of their taxes. They want the income that's been earned in the US. It's like here in the UK, they want their taxes. So I suggest if you need to speak to somebody in that situation, then give us a call and I can get you in contact with one of my corporate tax team that can help you with that.
Okay, thank you for that. I think what we'll do, Patricia, when we send the slides to everybody in the next 24 hours, we'll also include your contact details if you're happy with that.
Yeah.
Thank you for that. Next one down is bond winning taxable? Isn't it like a lottery?
So it is, but it is taxable. It's because you're receiving income. gambling winnings are taxable in the US. Any income, as I explained, is taxable for US tax purposes. So even if you win the lottery, if you win the premium bonds and win the million, it will be taxable for US tax purposes. And of course, you're not paying UK taxes, so you can't take a credit against UK taxes. So you will be taxed on those winnings.
Yeah, okay, fine, thank you. And then would lottery winnings be taxable in the USA?
Yes.
Okay.
Yes, they would be. But I must admit, if you won £10 here or £2.50 here, we do on our questionnaire when we send that to a client, said like, have you had any gambling winnings, lottery winnings? I'm sure a lot of our clients don't, and like say I've won £10 here or there. If you won a substantial amount, it would be taxable in the US.
Okay, thank you. Somebody missed the very beginning of the meeting, but they're just inquiring, does your company deal with tax on both US and UK side?
Yes, we do have a UK department as well, but our main focus is US. So if you have an individual that you want to still do the UK taxes, we will work with you hand in hand to do the US tax returns. But we do have a department as well that do UK taxes, because you have to know the US and UK taxes, because you may have to take a credit if they're paying US tax. You don't want to be double taxed on their income. So you just need to understand what's happening on the US side and the UK side. Because on the UK side, again, you're taxed on a worldwide basis as well if you're resident for UK tax purposes. So you want to take a credit if they're in the UK, if you want to take a credit for UK taxes on the US tax returns to avoid double taxation. So we deal with both US and UK.
Right, lovely, thank you. We've got somebody asking for a recommendation from you. Which books or notes would you recommend to develop a deep understanding of US tax?
Well, you could always look at the IRS website. There is I could maybe have a Google, but in the US, there's a Dummy's Guide to US Taxes. There's lots of them, like the Ernst & Young's have a Dummy's Guide to for people understanding US taxes, but these are all in the US. In the UK, there isn't many books on US taxes, but there are books in the US on basic understanding of each form, how income is taxed, if you need to get an understanding. But I can send you some links to some websites. Okay,
well, if you could kindly send us those links before we send out the slides, maybe tomorrow, then that's great. Thank you very much indeed. Another question, is there any double tax agreement?
So I didn't go into great detail about this, but for earned income, if you have paid UK taxes on your earned income, you will receive a credit on your US taxes. You should not be double taxed on your income. So, but for ISAs, if they're tax-free for US tax purposes, so you would be subject to taxes in the US because you're not actually paying UK taxes on it. It depends on the income. If you've paid UK taxes on any of this income, you will receive a credit for it on your US tax return.
Okay, thank you.
I should also explain that for earned income, you do have a foreign earned income and foreign earned housing exclusions for people overseas. Depending on which country you're in, there's a different limitations. But roughly if you're in London, you would receive a housing exclusion over a certain threshold and income exclusion of up to about $100,000. It can be excluded from your earned income. So people believe that if their earned income is below this threshold, they do not have a US filing requirement, but you still have to file a US tax return to claim this exclusion of income, because your income is below if your income is over $10,000, you have a US filing requirement.
Okay, thank you very much. For UK residents and non-US residents, if they have any USA income, such as property rentals, how does this affect and what should they do?
So if they have a US rental property, they should file US non-resident tax returns to report this income. So explain, even though their income may be, say, 10,000, their expenses may be 10,000 or even larger. Say if their expenses are even 12,000, you want to be filing on a yearly basis to carry forward this loss. This loss will be then offset. This loss will reduce your gain when you come to sell the properties. So you should be filing a US tax return on a yearly basis for your US rental property. Some people come to me and they say, well, I'm selling my property, and I'll say, have you filed US tax returns for this rental property? And they say no. So we would file the last 3 years of the US tax returns just to get some of these expenses to maybe offset the potential gain that they may have when they sell this property in the US. So it is very important. This is the IRS are trying to track down these people as well, because when you receive income from the US, from a rental agent, that income is reported to the IRS. The IRS knows that they've received income of 20,000, but they do not know they have expenses to offset this income. So they think they've got income of 20,000. Where's my taxes on this 20,000? So you should file a US tax return to report this income.
Okay, thank you. Right, another question. We set up family investment companies, and these have investment operated by discretionary investment managers. W8 BEN forms are required, but we get different feedback on which status applies. Most recently, Cazanoves say they should be active NFE. Is that correct? And I hope I've read that out correctly.
I would have to know more facts regarding that, because it could be a WBNE for FATCA purposes, and it is FATCA. So we have a special department in our offices that deals with FATCA. So we would need to know more information. We would need to know more information regarding that one.
That's fine, Patricia. When we send these slides and your contact details tomorrow, I would suggest the individual there follows up with you directly. How can protect income tax if the economic recession, sorry, I have read that. How can protect income tax if the economic recession? I'm sorry, I'm reading what I've got there, but I'm not quite sure what the...
So if they've received income, as I said, over a certain threshold, depending on this like status, the single, married filing, separate, married filing, joint, there is a different income threshold. If you're above that threshold and you've received income more than that, you have a filing requirement. So if you've worked, say, January, February, March, you will be over that limit. So you would still have to file a US tax return. Okay,
right, thank you. Client is UK citizen, but want to file USA, definitely forward you. Oh, definitely, right, okay, they'll pass on the details. Here's some feedback for you, Patricia, thanks. Very interesting. Right, somebody's asking, would welcome another talk relating to corporate tax issues, companies investing in US companies. I don't know if that's something that you or a colleague could help on.
We can do. We have, as I said, we have a corporate tax team, and they would be happy to do a further presentations, maybe early next year, before, because they kind of have busy seasons. So anytime, maybe in February, once your UK tax deadline's over, to help them. So we can. I can speak to you, Jonathan. We can arrange something. But yes, I agree. To understand, because a lot of people have these limited companies here in the UK, so it's a good understanding to understand corporate tax. I agree.
Okay, lovely. Well, I've scribbled that down, so we'll talk offline. Somebody else thanking you for your presentation. So many thanks. Another thank you. Right, how much is exit fees if someone wants to renounce their US citizenship?
So if they're below the 2 million and they have filed the last 5 years of US tax returns, and their average tax liabilities for the last 5 years is less than 168,000, then there's no exit tax, but there's an exit fee at the moment of $2,350. So for you to give up your US citizenship, there is a charge. Previously, years and years ago, the IRS didn't click onto this. It used to be like $150. So because a lot of people that are resident here in the UK have started giving up their US citizenship, they're trying to get more money out of people just before they renounce their US citizenship. So the fee is just a fee. It's not a tax. It's a fee of $2,350. But if you're above the threshold of 2 million, there could be exit tax. And I would advise doing some tax planning beforehand before you relinquish your US citizenship. But at the moment, the US Embassy in London has been closed due to COVID. So like lots of my clients are trying to give up the US citizenship, and the IRS or the US Embassy in London aren't accepted any appointments this year. So a lot of people may be expatriating come 2021.
Yeah, okay, thank you. If the US listed shares are sold within 1 year of purchase, do we need to pay cap of, I think that's $5,000? And then further down, somebody has also added, well, the person who's asked that question, shares were bought and sold from a UK share dealing account.
So if they were in the UK, for a UK portfolio, the IRS do not know about these shares. So they shouldn't be subject to US taxes if they've been like in the UK accounts. But strictly speaking, they should, but under the US-UK tax treaty, let me explain, under the US-UK tax treaty, for a non-resident, capital gains are taxed in the country of residence. So they're taxed in the UK. So even say, just say still in a UK portfolio, there'll be no taxes. If it was in the US, sometimes they withhold US taxes 15 to 30%. But as I explained just a minute ago, under US-UK treaty, capital gains are taxed in your country of residence. So you would have to file a US tax return to avoid, to get back the US taxes withheld. For estate tax purposes, the question was more for, when I mentioned it earlier in my presentation, for estate tax purposes, if the assets, when the person passes away and the assets are in the US, the US portfolio would, like Fidelity, JP Morgan, they will ask for a transfer certificate. So then you would have to file a US estate tax return. So there's a difference between estate and income taxes. So you just need to be very clear. Okay. Income under the treaty is exempt capital gains, but under estate taxes, if the assets are in the US, then you would file an estate tax return.
Right, okay. I think the individual has also added a little bit more, actually, Patricia. I mean to ask, do we pay capital gains on shares bought and sold from UK share dealing account? The gains are less than $5,000.
So as I explained, under the US-UK treaty, capital gains for an individual is exempt from US tax purposes. But if they were in a US portfolio and US taxes were withheld, then I would suggest filing a US tax return. But it depends. If this client is a non-resident of the US, then you would not need to file a US tax return. If the assets were in the US, then you would have to file a US tax return. So it depends on where they're living. So situation, if they want to discuss, they can call me.
Fine. Another question. If you are both domiciled in US and UK, but I live and resident in UK, do I still need to file tax return with US?
Yes. Okay. Because you are a US citizen. So if you have a US passport and you are a US citizen, you still need to file, if you have earned income, you need to file a US tax return on a yearly basis.
Okay. Thank you. Does your company deal with Canadian tax? We've been asked.
No, but I could probably give you a contact of somebody that can help with Canadian taxes.
Thank you. There's another request there about a different talk, but that's great. Do you deal with research and development issues arising from US citizen owning limited company?
Yeah, I think as explained, I think maybe when we have a corporate presentation, the corporate team will be able to help on that one.
Okay,
yeah.
So we can cover R&D there. A number of other thank yous, Patricia. So that's great. Okay, UK citizen and resident received a gift of shares from great uncle, who was a US citizen approximately 30 years ago. Shares now valued at approximately 29,000 US dollars, but suffering withholding tax on the dividends. Can this be received gross?
So if they are resident here for UK tax purposes and US taxes are being withheld because they're taxed here in the UK, you would need to complete a W8 BEN, and you would then submit that form to the dividend with the financial institution in the US to say, under the US-UK treaty, the dividend income is taxed at 15% in the US and in the UK. So if they're taxed at 15% here in the UK, you then submit a W8 BEN to say it's being taxed here in the UK. So because it just avoids filing a US tax return to get, say, like $100 back, but that $100, it's not worth filing a US tax return for $100. But yes, completing a W8 BEN and submitting it to the financial institute in the US.
Thank you very much. Good. I appreciate we're tight on time, but I'm going to continue because there's a lot of questions coming from an excellent session from Patricia. So there are only a few more, so please do bear with us. And in fact, Patricia, the next three are a thanks for your presentation. Excellent webinar. So thank you again, Patricia. Not quite sure whether this is a question, but somebody's just put Streamline Program. I don't know whether they're asking for a little bit more clarity or information there. Yeah.
So, as I explained, the Streamline Program is the IRS way of people to get back into the US tax system. So some people may have filed a US tax return when they were living in the US till they were, like, say, 21, 22. And then they've come to the UK and they've said, well, I'm taxed here in the UK on my earned income. Most people just have, say, salary. So why should I be paying US taxes? But they should still be filing a US tax return. So these people need to then go into the Streamline Program, because people say, well, I'm taxed here in the UK, so I didn't think I needed to file a US tax return in the US. So you would then go onto the Streamline Program and explain that I'm being taxed on my income here in the UK. I wasn't aware that I had to file a US tax return until my accountant or somebody told me, which is normally the case. And then I'm coming forward to get up to date with my US taxes and to get back into the system. So you would file under Streamline, which is the most free current year's US tax returns, and the 6 years of your report of your foreign bank accounts. And the report of the foreign bank accounts is the highest value of your foreign bank accounts for the last 6 years. So even if one account was 5,000 and then one account was 6,000, you would still have to report both of those bank accounts because you were over the 10,000. Just say it was $5,000 and $6,000 when you do the exchange rate. You would still have to report both of those bank accounts. So it would be the highest value.
That's lovely. All right, Patricia, I'm going to end with some thank yous, not just from me, but some of the audience. Absolutely first-class presentation. Many thanks indeed. Thank you for your excellent presentation. Very informative. Thank you, Patricia. Very informative presentation. I think that says it all, really, from me and the Institute of Financial Accountants. We're very grateful for the talk that you've given this afternoon. Members who approached me months and months ago about this particular subject matter were obviously right. I never doubted any of them, but you can just see by the interest and the questions that have come at the end that this is obviously a hot topic for our members. And I think it's also given us topics for the future, because yes, we've got corporate tax issues. Somebody's put, or I've scribbled about starting US in unincorporated businesses. And obviously people have asked about research and development. So we'll discuss that offline, Patricia. But again, from the Institute, many thanks for your time today. It's been gratefully received. So thank you. Before everybody rushes off and gets some lunch or covers off emails or gets to another meeting, I won't put up slides again because I think that sort of holds us up. Just a few reminders from an Institute perspective, please. all members will have received communications from us about the renewals of membership and member firm renewals where it's applicable. Please don't ignore those emails. Please action them. Renewing your membership is about paying that annual fee, but it's also about completing in full that annual declaration. Really important. Member firm renewal, exactly the same. It's about paying the renewal fee, but it's also about completing in full the needed declaration. So please do take a look at those emails if you've not already done so. Just again, lots of changes in these COVID-19 times. The Institute's COVID-19 resources page is constantly updated with information, a range of information that is hopefully helpful and supportive to all members. And please don't forget about the member support group, where if a member was looking for a bit of support, advice, wanted to talk to a member of that group from maybe a soundboarding point of view, that group is there to help take your emails or your calls. We still have a number of webinars and CPD events coming up between now and the middle of December. There are a number of national, local branch surgeries taking place in Scotland, Kent, Yorkshire in the coming few days and into next week. So please, if you've received your local email, do register and take part in those. The next national online branch meeting is this time next week, the 24th of November. And then the last national online branch meeting of the year is the 9th of December. For those of you who are thinking about starting out in practice, or maybe have only been in practice for 6, 12, 18 months, we do have the Starting Out in Practice webinar series beginning on the 26th of November and then continuing on the 2nd and the 10th of December. In early December, there is the final financial reporting and accounting treatment webinar of this particular year. Again, they've been well received by members. Some fantastic information and detail contained in those sort of 2.25, 2.5 hour sessions. I would strongly advise you to register for that. And then 10th of December, Receipt Bank are running a final webinar of the year, all about monthly recurring revenue and ways to either enhance or grow that. So a range of webinars and CPD events. Institute website, www./CPD for all of that information. Don't want to end on a sort of negative note, but please do remember the requirement for CPD in this calendar year is 40 hours. 20 of those are verifiable, 20 are non-verifiable. Thank you to everybody who's been on the webinar this afternoon. A huge thank you once again to Patricia. Just from the feedback, I think you can tell and see that your presentation has gone down extremely well. We thank you for your time. We will send out slides with your contact details tomorrow, but it's much appreciated. To everybody else, stay well, keep safe, and we look forward to seeing you soon. Thank you all. Thank you, Patricia.
Thank you. Bye.